Okay, very good morning then. Welcome to the briefing for Wednesday the 26th of October. A quick look at the pound this morning before we then move on to some of the movement we've had in the equity markets to the downside already this morning. Because obviously given the movement that we're seeing yesterday in the pound, well firstly, we had this big move to the downside, and why did that occur? Obviously we were talking about that quite a lot at the time of when it was happening. And really it was, obviously there's the kind of bearish macro picture around the Brexit situation. You've got the hard Brexit calls. That's been the main downward catalyst for some time since that Tory conference, with the response now being equally robust from Europe about, if you want to leave, then it will only be you either stay or it's going to be a hard Brexit. You've had Nicola Sturgeon as well causing some headache for May's plans, and then Chancellor Hammond yesterday giving quite a clear backing of further quantitative easing, and that he would support that going forward, which would be obviously a dovish occurrence in terms of the currency. But more so it was the break of various technical levels on the descent. If you look slightly, this is a slightly longer dated chart. And it was that kind of 2150 level, which was the support that was found around the 13th and the 17th. When that broke, it kind of added to the momentum to the downside. You can see from yesterday it was a pretty swift move, and it's almost one of those things that becomes self-fulfilling, and people start chasing the price action until they see the next logical point to pull the trade and book their profits on the shorts. So 121 handle, which I guess looking longer dated here makes sense. It's a 240-minute candlestick. You can see that low print that came in back on the 11th, and then we bounced very aggressively there forward. Obviously at this point as well, there's a lot of murmurings about pre-positioning ahead of Mark Carney, who spoke in front of the Lords Committee yesterday, but lo and behold, Carney keeping his cards close to his chest, not really saying anything out of the norm, certainly nothing overtly dovish to create that move, and you saw a complete reversal of the move. There may have been a lot of people thinking that potentially this is a bit of front running ahead of some comments that he was to make, and obviously those did not materialise. And so although we did dip slightly overnight in Asia and sterling, we have come back up to gravitate back towards that 122 level. Looking in context though, that 121 really is a significant level. You can see then if we were to make any reapproach of that, below there, that's the algo flash crash that you can see that occurred on that Sunday evening. Don't really see that being too much of a significant level, but certainly something that other people will look at in the futures market at 2034. And still the prevailing trend is, this is a chart we showed a few weeks ago. I've just still got it up on one of my tabs. This is the current Credit Suisse year-end target, Goldman Sachs target slightly below, so 116, 114 respectively. And on a hard Brexit, I think this is GS's call. They're looking at a 1 year horizon on the back of that down at 105 for the currency. So to put in a bit of perspective on a slightly longer term basis. But certainly that 121 is key. If we were to see any type of move on there, then certainly 120 would come under assault. And then that's just a big psychological level there for the market to target. So that's kind of your state of play in sterling. Obviously from the UK High Court ruling situation, no real developments there, but as we were saying in yesterday's session, at some point this week we could hear some commentary around that matter, and obviously anything that goes in favour of the case being brought forward in order that the MPs in Parliament need to ratify these Brexit decisions would be a sterling positive, as it would force the government to come off its hardline stance slightly. Otherwise, looking at the DAX this morning, obviously we've already come under a bit of pressure from the futures open, and then when the cash markets have opened, that's just seen some additional move lower through S1 down to close to testing S2 before this latest bounce to sit just above 10,700. Quite interestingly then, looking at the way that we started the week, we obviously had that German data which was solid. The PMI numbers, that caused the bulk of the rally up towards that kind of more towards 10,825 around the highs. And we've reversed that entire move already. So a couple things at play. One thing is earnings season. And obviously we had a very big company. I'm sure you've all read the headlines by now, but let's have a quick talk about Apple. This was Apple's share price last night. Upon the release of the results, we blasted higher, and then we reversed course pretty much within a few minutes, and then moved 2% lower in extended hours trade. Now, the reason why you get this kind of two-part price action, you get the first initial blip. Usually it's because markets react to the first thing that they see. And the first headline run on Bloomberg was actually the EPS number, which was actually a penny beat. The other thing as well that investors latched onto was that they actually see their Q1 revenues, because this is Q4 that Apple reported last night. Their Q1 revenues were they foresee 76 to 78 billion. That's a big increase on their prior outlook of 75.4. Positives then. The only thing is though, when you start scratching beneath the surface, their revenue number actually missed. And that is very significant, because from a revenue point of view, Apple missing really doesn't happen. It's the first time Apple posted an annual profit decline since 2001. As 2/3 of revenues it gets in the iPhone expose it to the waning smartphone demand. Now, there's this chart here, you can see it gives Apple in a bit more context between their net income and their iPhone sales year on year. You remember that kind of block chart that I showed you yesterday, where something like 70% of the company's profitability is all dependent on performance of the smartphone. And you can see here, as their iPhone sales year on year, especially towards 2016 and more recent quarters, has lagged, as too then has the overall company's profitability. So really it's that iPhone area that's been a real weakness for them. Now, this is quite an interesting chart as well. You can see here each bar denotes a year, as you can see from 2008 running up to 2016, which obviously this is each quarter going through 1, 2 and 3. You can see in terms of the incline that we've been on since really 2008 all the way up to 2015. This is one-way traffic in terms of Apple, really, on a revenue basis. However, if you were to look at 2016, i.e. the orange bar, dropped in the 31st of March reporting period, dropped again in June, dropping again in Sep. You know, this is a slightly worrying trend from a company that's punched higher in revenues consistently by a large margin for a long period of time. The big one as well that's interesting is the fact that Apple sales by region year on year change. Now obviously Apple has made a concerted effort in order to enter the Chinese market, and that initially was met with applause. You know, the Chinese consumer saw it as a kind of how's best to describe it, it's almost like a fashion accessory, so to speak, and a sign of wealth in China is what it means to own an iPhone. And if you have been to China, obviously anything that's kind of in the Western world they deem as to be higher quality and so on and so forth. But China is massively lagging on that regard after that really strong start that they had, and that's quite a worrying thing going forward. The only slight positive though that I did see was the diversification. We spoke about the likes of Google, Microsoft, the latter moving into cloud technology and putting a lot of their company's infrastructure into that direction, which has been very positive for Microsoft. However, for Apple, services has been a key thing. Obviously, when the iPod and the iPhone were first made, it's the applications actually and the services around the phone which are really important. And you can see here, iPhones, this is year-on-year revenue. iPhones are down, Macs are down, iPads are slightly down, and everything else is down. The only thing is up is services, and it's up considerably, and that's important. So this is where the future kind of lies now with Apple, given the lack of innovation with their core product group. So I just thought that was interesting. That's Apple, and obviously they're one of the largest companies on the planet, and therefore them being down 2% can explain some of the negativity that's set in not only the close in Wall Street or aftermarket yesterday, but we had a negative tone in Asia, and then that is translating onto our charts when we've come in this morning with lower DAX and in sympathy S&P future down as well. Now from an earnings season perspective, after the banks, which were surprisingly robust, it hasn't been particularly great from the US perspective. Now, you can really break this down into three different areas. You've got people like Under Armour, not a big company, but certainly a company that has exploded in terms of popularity and share price only a short while ago. However, they were down double-digit declines after their earnings report. General Motors fell 4% on disappointing outlooks, and we may have gone over the peak in auto sales. Caterpillar, now that's a really important one, that came out yesterday, and they're seen as a bellwether for the industrial sector. And while earnings bettered expectations for the current quarter, revenue slid more than expected, while the outlook for the remainder of this year and next year was more subdued than was hoped. So this is the really key point. And you saw this with a couple of earnings. I had a few questions yesterday. It's not so much about the current quarter, that's almost priced in. What's important now is how is the economy and how are these companies going to fare going forward. So it's the outlook on the next quarter and the next full year that's really important, and that actually has been pretty weak for a lot of these US companies. So that's definitely something to keep an eye on. The other thing that's been obviously weighing on equities this morning has been crude prices. You can see here that was at 9:30 last night. I've just highlighted it for you on my charts. We fell from roughly 49.80 all the way down to kind of 49.20. And for those of you who've seen the API numbers come out week after week, that's actually a pretty punchy move as far as oil goes. And why did that occur? So API inventories last night, crude inventories rose by a bigger than expected 4.8 million barrels. Expectations were for 2 million. So an exceptionally large build. Cushing though was a pretty big drawdown, and certainly a bigger drawdown than expected, so that may have negated slightly some of the bigger move to the downside. But gasoline was bearish for prices, build of 1.7 million, distillates was a draw of 940. So the market really latching onto the headline figure. It's slightly negated by impact by the Cushing, but the gasoline certainly bearish as well. And obviously we'll be looking out for those oil inventory numbers a bit later on. One of the other things though, looking at oil slightly longer dated here. Let me just, so this was the move last night. And in context, slightly longer dated chart, you can see we've kind of been a couple of key levels, 51 more recently to the upside on that move that we saw towards the end of last week and the beginning of this week. And then this kind of 49, 70 type level being broken. I mean, it was tested and bounced aggressively on the 24th, but the API is being enough to really firmly break that to the downside. And don't forget, this price has been somewhat elevated over, well, really, this is, look, dated back to the beginning of the month. This is when you've had the Algerian meeting, the commitment, the surprising coordination between the likes of Saudi and Iran and Russia getting involved, talking about trimming overall production. But since that point, yesterday, obviously, we had some comments out of Russia. The nation's envoy at OPEC said that production cuts are not an option for us. This comes after some similar type comments we had out of Iraq, and they were saying, of course, at the weekend, although that's been downplayed slightly, they did say that they want an exemption from having to cut their own production. So let's think about this. You've got Russia, one of the biggest producers in the world, and you've got Iraq, the second largest oil producer within OPEC, both getting slightly cold feet about this agreement. Don't know if you saw that tweet from Piers yesterday, our head of trading. He is saying, and I totally agree, that this deal that they've struck will not come to fruition. Likelihood is it will break down before that end of November meeting, and obviously that would be a bearish result in terms of prices. But certainly oil down 50 cents. Be interested to see how the US react technically as well. Now we're below those kind of supports with the move from last night. That will act as a secondary headwind as well for equities. If you remember yesterday, I was showing you the correlation matrix. We were around a 92% correlation between WTI crude and the S&P yesterday. So again, I'd be watching that as this session progresses. Just going back to the earnings picture, though, there's a few other things that I just quickly wanted to show you. Lloyds Banking Group this morning in the UK, their quarterly profit fell $1.2 billion on PPI charges. They're still getting penalised on these PPI charges. So don't forget, Lloyds, out of all the banks in the UK, is Britain's largest mortgage lender, and a 15% decline in third quarter profits to compensate for customers who are wrongly sold loan insurance. So they are under pressure this morning. So that's kind of your equity picture. Obviously the bias this morning certainly to the downside amid those two main catalysts being disappointing earnings and also the oil move from last night and the general carry through of negative sentiment in Asia with Apple earnings disappointing. A quick look elsewhere though in commodities is what I wanted to look at, and let's just take a quick look at gold. Now gold is up marginally this morning. We're up around $2.50. But as you've known, Will is a big trader of gold. It's one of his favourite assets, but it's been a very tricky one. And you quite easily get caught out at the moment because rather than gold reacting to this classic kind of risk on, risk off or flight to quality type trade, actually gold has been moving up quite steadily. In the case of yesterday, certainly. And if you look on slightly longer dated, after we had that flush lower on 1300, which was really at the beginning of the month, if you remember, that was when we kind of breached those key levels, that resistance pre-Brexit, then the break below it on 1300. We had that one day with a pretty huge downside move. Since we hit that kind of psychological 1250 mark, we've actually bounced about $25. Now there's one thing that I want you to keep in mind when you're trading gold, and that is gold's seasonality. Because one thing to keep in mind is the physical side of gold, because not only is it a risk asset to trade in that regard and the kind of inflation hedge on monetary policy, the other part is people actually buy the physical commodity, unlike speculative markets. And this is important because of approaching seasons. So India in particular has a very important one coming up, and that is Diwali. So if you're looking at physical demand in India has been weak, but support is seen returning before the festival of Diwali, which starts this weekend. And you've also got Indian wedding season. So culturally, obviously, along with China, in India, gold is very important in terms of the giving of gifts over these particular periods, and therefore gold actually has an underlying physical support on the back of that. Goldman Sachs says that further weakness in Chinese currency and investors' concerns over the outlook for property may spur gold demand as well, because gold being the kind of more traditional safe haven, as we just said, and any hot property that you often see talked about, property bubble in China, obviously you want to be hedging that off with potentially buying of gold. That in combination with the physical side then going into the Indian festival and wedding season means that that's going to be something interesting to watch going forward. Just quickly looking at the charts, just seeing euro dollar seeing a slight move to the upside here. We had a fail kind of break of that R1 a couple times. So just getting a bit of an extension here in euro dollar to the upside. You can just see there. Dollar is down this morning around 0.2%. So anyone looking for a persistent punch low in crude oil might be disappointed, because obviously the inverse relationship, if the dollar keeps weakening, that might act as a bit of a barrier to stop the shorts in oil and support prices. Okay, just wrapping up then, a quick look at the election side of things, and this is the chart I showed you yesterday, but significant because according to the latest polls by Real Clear Politics, Clinton is over the line. She is your president, irrespective of actually having to win a single swing state. This is because Trump and his popularity, particularly in some of the more historically Republican-leaning states, if you look at the map, Texas has actually turned into a swing state. And I think that is massive in terms of a psychological play. Texas, you would imagine, and given previous voting patterns, to be a Republican area. However, that is now seen as a toss-up state and part of the swing state collection, given the way the polls in that area are so close. So looking good at this point. On the 538.com website, which is another very followed website for US politics, you can see Clinton, irrespective of Iowa, Arizona, Ohio, North Carolina, Florida, Nevada. Even if she lost all of those, she would still be over the magic number of 270 to win the presidency. A quick look at one thing, though, actually, is just to clarify, is the difference between the popular vote and the electoral vote. Because one thing in the US is that dating back to the likes of 2000, you had actually, this is when it was the Bush era, he lost the popular vote but became president. Now, the popular vote is the number of individual votes casted, whereas the college vote is the votes cast by states, and the number of votes does vary. So really, it's about the college votes, which is really essential to winning the race, not so much the popular vote. And so, yeah, as you can see here, in the closely contested election in 2000, which was Bush v. Gore, Bush won Florida, but actually that was a 50-50 split with popularity. It's just the fact that he pipped the post, and so therefore he won all 27 electoral votes for Florida, which is obviously the biggest of the swing states. And actually, when you start to map that out on a broader perspective, from a popularity point of view, you can see a lot of this is actually Republican. But because of the key collegiate voting system that is present in the US, Clinton actually has this by quite a clear advantage. Now, talking to Piers briefly this morning, I can't help but feel that Clinton's strategy is coming perfectly on point in terms of timing, in that being that Donald Trump was never a serious contender and was actually put forward to make Clinton more digestible to the public. Call me a conspiracist theory, but I think that's pretty common knowledge, that as a viable way of looking at it, because these two, let's face it, they're mates before the presidential race begun. But there you go. Okay, a quick look at the calendar for today. Let me just bring it up, and to look out for a few other things. So obviously the oil inventory numbers, of course, we'll look out for later, just given the fact we had that quite strong move to the downside yesterday. The High Court ruling, again, I do not have any set time for that. It could come any moment. So if you are in any sterling trades, I would again suggest that you just be proactive with your management and try to limit your time of being exposed in an open position is the best way to counter that. In terms of the actual day in itself, Not too much from this morning. You've got UK mortgage approvals, and if you read some of the headlines from this morning's press, there's a couple of industry bodies saying that London house prices are going to fall going forward. Obviously, the more higher priced areas have already been declining by double-digit amounts, but broader London is forecast to decline. But mortgage approvals to look out for, but unlikely to have too much impact. It's going to be this afternoon. You've got the US service PMI, new home sales, and those crude oil inventories will be key. No actual notable speakers today. Okay, guys, that's your briefing. So you've got a bit of a touch of risk off this morning in terms of lower equities. The dollar, though, has weakened, this being irrespective of the hawkish line being taken by the Fed. I think that's been pretty much priced in from that type of commentary. And so getting a bit of a lift in the major pairs on the back of a bit of a pullback in the greenback this morning. Okay, enjoy your day, and I'll see you in the chat room.